Hi, I'm Monica from Numberly, and I just wanted to briefly walk you through the issue of valuation, something that is really important for so many of the startup founders that we work with. And there's a few different methodologies that you might think about using. One is comparable, so looking at other startups that are like you in the same vertical, for example, that have been successful. Another is revenue multiple, and the one that I'm going to talk about today is discounted cash flow, or DCF. And one caveat before I kind of get into the detail of DCF is that you should definitely be aware of is that valuation is much more art than science. And at the early stage, it's very, very difficult to know exactly what the potential of your business is. It's very useful to have a sense of what your valuation is when you're going out and fundraising. You absolutely need it, even if you may be raising through, for example, a safe note, which pushes the valuation discussion till later. But it's a really good idea to have a financial model and use it to at least get a sense, even if it's only internally for your own team, of what is the potential of our business, what might it be worth if we're able to hit these assumptions that we're embedding into the financial plan, financial model. So in terms of the DCF methodology, the way that it works is that the financial model is going to give you a series of cash flows that the business will be generating over time based on the assumptions that you're entering for customers and revenues and costs. Those cash flows, because they're happening in the future, need to be discounted back to a value today, which gives us our valuation today. And the way we do that is, again, using a discount rate, as the name implies, discounted cash flow. We're taking future cash flows and discounting them back to today's value. And you want this discount rate to be sufficiently high in order to compensate investors for the significant risk that they're taking in investing in your startup. Typically a rate like 30 or 40% is going to be very common in valuing early stage startups. And what the model will do is it will take the cash flows in each year and it will discount them back to today using the 30% rate. That then gives you a valuation based on the 5-year cash flows. But because your business is going to continue beyond 5 years, there's all these cash flows that the model is not accounting for using that discounted cash flow over 5 years. So you want to also assume there's a growth rate that happens thereafter. And in order to do that, we forecast a growth rate beyond, in this case, 2027. And we assume that our cash flows are going to continue to grow at that rate. So, for example, if we choose something, again, conservative, like 3%, which tends to be, this rate tends to be something around the inflation rate, and we assume that we're going to continue growing at 3% into perpetuity, basically. And we take all of those future cash flows based on that 3% growth rate after 2027, and we also have to discount those back to today because they're happening in the future as well. And that gives us what's called a terminal value. And the terminal value gets added to all of the cash flows that we've discounted back to today for the 5 years of the model. We add those two together, and that gives us a valuation. And in this particular case, because these numbers are in thousands, this startup is going to go and try to raise at around a $5 million valuation. I hope that was helpful, and if you have any questions, please go to help.numberly.io. Thanks very much.